So this month we are driving Smart Edge Plus, and these are our internal sales team who are direct point of contact to customers. So we will be telling them about research strategies which we use for Smart Edge Plus. What is the market outlook with respect to our Smart Edge Plus, and what can be the pitching points in terms of research, like how consistent we are, how unbiased we are, and what are the strategies which we are using to select stock, rebalancing, and all. So basically, normal research call which will help them to pitch this product more confidently. Yeah, yeah, no problem. You give your presentation, and then yeah, yeah, that is okay. Yeah, we'll do. We can do that thing. वो इधर ही रहता है. Yeah, sure, sir. Hello.
Hi, good afternoon, everyone. Welcome to today's session. We'll be starting in a few minutes when our guest for the day joins in. Please be patient for the time being.
Good evening, everyone. It is my pleasure to introduce a remarkable leader in the financial service sector, Mr. Nilesh Shah, the Managing Director of Kotak AMC. With over 25 years of experience in capital market, Nilesh Bhai has been instrumental in shaping up the investment landscape in India. Nilesh Bhai's career is marked with series of prestigious role in leading financial institutions, uh, including Axis Capital, uh, ICICI Prudential, and Franklin Templeton. His expertise spans across equity, fixed income, and real estate, making him one of the most respectable voice in the industry. Notably, he was awarded an inaugural Business Standard Fund Manager of the Year award in 2004. Nilesh Bhai, alumnus of Institute of Chartered Accountant of India and gold medalist, is also a merit ranking in cost accountancy. His impressive academic achievement have been a foundation of his successful career. Leading Kotak AMC, Nilesh Bhai has skillfully navigated the company through changing investor needs and market shift, helping the company to prosper. He is well regarded for his sharp insight into economic trend and managing complex market scenario. His recent talk in industry forum highlighted his unique mix of humor and wisdom, making his investment advice both engaging and impactful. In one of his investment forum, I still remember he has given a new abbreviation to SIP, that is Sarva Ichha Ki Purti. In addition to his corporate role, Nilesh Bhai served as part-time member of the Economy Advisory Council to the Prime Minister of India. He is also on the board of MFI and member of a various SEBI committee, where he provides valuable insight to shape the future of the industry. Beyond his professional achievement, Nilesh Bhai is passionate about educating investors on financial planning, co-authoring a book titled A Direct Take, which emphasized the importance of informed investment decision. Please join me in welcoming Mr. Nilesh Shah as he shared his insight and vision for future of investment in India. Over to you, Nilesh Bhai.
Thank you, Samir Bhai, for that nice words of introduction. It's always good to speak with Axis Securities people. For a while, I was associated with Axis Securities, and I have very fond memories of that. I hope you are able to see the presentation.
Yes, sir, we are able to see.
Okay. Unfortunately, I'm not able to move that to next slide, which is very surprising. Technology is ahead of me. But forget the, okay, here it should come. Yeah, thank you. So if we look at the global economy, there is a risk of the US is either going into recession or doing soft landing. There is Israel-Iran conflict. There is unwinding of yen carried trade. China is slowing down and Bangladesh is in crisis. This geopolitical risk is creating risk off. Let's look at our economy. We were coached to the global growth train. Now we have become engine. On an incremental basis, we were contributing low single digit to real global GDP growth. Now it is mid single digit, and eventually it will become high single digit. डिब्बे से engine बन गए हम global growth train के. That means कुछ तो हमने सही किया है. The challenge for our growth is essentially uneven growth. There are urban areas like Mumbai, Delhi, Kolkata, Chennai, which produces about half of India's GDP. 13 urban clusters gives half of India's GDP, and balance 692 districts gives other half. अगर आप बंबई, दिल्ली, कलकत्ता, चेन्नई, जयपुर, अहमदाबाद, सूरत यहाँ पे है तो you think India is growing. But if you are in other parts of India, your perception of growth will be different. Always remember, when we say something about India, opposite is also true. Outside my window, I can see Geo Complex, where one of the most extravagant wedding of the world happened. And from the same window, I can see Dharavi, which is Asia's largest slum. In India, we have a developed world, but only 1% of population is as rich as developed world. 27 population is middle income, and 72% is below poverty line. Obviously, we have to keep people shifting from lower middle class to rich over a period of time. If we look at our economy today, numbers are very good. We are the fastest growing major economy in the world. जैसा मैंने पहले बताया, अब हम दुनिया की ग्रोथ ट्रेन के इंजन बने हैं along with China and America. पहले दुनिया चलती थी, हम चलते थे. Now we move and the world will move. CapEx cycle because of election was down, but that should pick up as the budget has provided 11,11,000 crore for spending on infrastructure. Infrastructure which we built in last 10 years is improving efficiency. Our share in global exports is rising for goods as well as services. Monsoon God has been kind to India with adequate reservoir levels. Oil has fallen down now to $70 a barrel. अपनी कुंडली में एक ही राहु है, एक ही केतु है. Oil ऊपर, हम नीचे, oil नीचे, हम ऊपर. We are now at the top amongst the emerging markets. Overall, economy has more positives and less negatives. Undoubtedly, there is unemployment problem, especially with disguised unemployment in agriculture. Consumption remains uneven. The rich and the poor consumption is moving in different trajectory. Power situation is little bit alarming as power demand is growing in double digit. But overall, we seem to be in reasonably good shape. Now let's come to the equity market. Everyone wants to know where will the market go. Let's first find out where will the market not go. If we look at market cap to GDP ratio, it is coming as 142%. 25,000 Nifty is about 142% of GDP. And average देखे तो पिछले 10-15 सालों की is about 85%. If Nifty has to come down to its historical average, it should be 15,000 Nifty and not 25,000 Nifty. We think that correction is not going to happen. We don't see India's market cap to GDP ratio coming down to historical average. Why do we say so? Because our profit to GDP has moved from about 4 lakh crore in 2020 to about 16 lakh crore in 2024. Please look at the bottom chart very, very carefully. Between FY10 to FY20, our profit moved from 3 lakh crore to 4 lakh crore. Net market cap just doubled from 62 lakh crores to 113 lakh crores. Then between FY20 to FY24, profit grew from 4 lakh crore to 16 lakh crore. Boom! market cap also went up from 113 lakh crores to 387 lakh crore. So as profits have grown, market cap has moved, and hence we don't believe there is large correction in market which can take us to historical average. Next, these profits are generating real cash flow. एक समय था लोग प्रॉफिट दिखाते थे और फिर पैसा बोरो करने बाजार में खड़े रहते थे. आज की तारीख में not only profit is coming on balance sheet, but it is actually resulting into higher cash and repayment of borrowing. So quality of profit has improved a lot. Valuation wise, we are little bit on the higher side. I don't know how formatting has changed over here, but somewhere don't look at the data. This charts doesn't look correct, but the down below table formatting is right. Large caps are at historical average, mid and small cap are little expensive. Our market has limited correction possibility because now domestic ownership is substantially higher than foreign ownership. लगान मूवी आप सबने देखा होगा. वहां पे लोकल लोगों की क्रिकेट टीम, किसानों की क्रिकेट टीम गोरों को हराती है. रियल लाइफ का लगान हमारी मार्केट में हो रहा है. मार्च, अप्रैल, मई, जून, जुलाई 2020 में कोविड के समय में गोरे बेचने आए थे, लोकल निवेशक खरीद रहे थे. Eventually foreigners were tired of selling, but local investors kept on buying. Then they came to sell during October 21 to June 22. They sold 2,50,000 crore worth of equity. Month after month they were selling, and yet local investor kept on buying. तो टेस्ट मैच भी हार गए, वनडे भी हार गए, T20 खेलने उतरे, इलेक्शन के रिजल्ट के दिन पे दबा के बेचा, रिटेल इन्वेस्टर पूरा खरीद के चले गए. So whether it's one day format, test match format, T20 format, capital market में, हमारी stock market में लगान movie is played, where local retail investors through mutual funds are able to absorb selling of foreigners. This also protects us on the downside, apart from fundamentals. Even FPI's behavior is 2 महीना बेचो, 1 महीना खरीदो, 1 महीना बेचो, 2 महीना खरीदो. कैलेंडर ईयर 22 बेचा, 23 में खरीदा. जैन, अप्रैल, मई में बेचा, फेब, मार्च, जून, जुलाई, अगस्त में खरीदा. तो ये भी एक रिवॉल्विंग डोर की तरह they are coming in and going out. Q1 FY25 earnings were little subdued, but market is still expecting Nifty 50 to deliver about double-digit earnings growth over next 2 years. If this earning growth materializes, then there is limited downside to the market. We will say, while we don't know the upside of the market, downside looks limited because earnings are good, domestic ownership is strong, and most importantly, our valuations are still reasonable as profits have kept pace with market cap. Now, in this market, where should we not go? Well, there are certain limited floating stock, low floating stock counters where ownership with public is very, very low, very, very limited. And that has resulted into some excess on valuation. For example, a bank like IOB is a very good bank, but they are trading at more expensive valuation than State Bank of India. And their P ratio is more looking like a FMCG company. We think that is attributable mainly to limited floating stock, as 98% shares are with President of India and 2% shares are with Public of India. This low floating stock counter is where one will have to be careful. If we look at market today, it's pricing in everything optimistically. सितंबर में फेड ब्याज की दरें काटेगा, गवर्नमेंट 5 साल चलेगी, भले 240 सीट है, ऑयल प्राइसेस नीचे गिरेंगे एंड इट्स एक्चुअली फॉलिंग, कंजम्पशन जो 18 महीनों से सबड्यूड है वो रिकवर हो जाएगा. डिस्पाइट इजराइल, ईरान, रशिया, यूक्रेन, चाइना, ताइवान, geopolitical risks will not flare off and double digit. If all this happens as per expectation, market has limited room to go down and it will continue to march ahead. Sectorally, first is FMCG index. FMCG index is relatively good with monsoon, election and overall recovery. We believe consumption today provides good opportunity to invest. And the second index is technology. We have seen some run up in technology stocks, but we think there is more opportunity. I'm sure all of you have seen Amar Akbar Anthony movie. In that film, there were two characters, Amar Bhai and Anthony Bhai. Amar Bhai was an upright police officer. Anthony Bhai दिल के अच्छे थे, but life में shortcut लेते थे. अपनी मार्केट में भी एक अनहोनी हो रही है. But stick with Amar Bhai kind of stocks where valuations are good and fundamentals are in place, rather than Anthony Bhai kind of stocks where valuations are expensive, even though fundamental might be in place. This is time to go for quality over momentum. This is time to go for high floating stock counters over low floating stock counters. And this is time to go for reasonable valuation over expensive valuation. SME index, I'm sure some of you would have heard about them. It is the world's best performing indices with 66% compounded return over last 10 years. I don't think so. World has seen anything like this. We don't understand this market much, but we think it's one of the most expensive market in the world from a valuation point of view, and hence one needs to be careful. In between Jan 20 to August 24, 88 stocks out of NSE 100 have doubled or more. In BSE 500, 359 stocks have doubled or more. Clearly, this is one of the biggest broad-based rally. While in some cases, rally has happened on profit, in some cases, P ratio has expanded. On Jan 20, there were 93 stocks with more than 100, more than 50 P. Today, there are 228 stocks which are more than 100 P. Obviously, higher P means more expectation. Please look at this one chart carefully. Between December 05 to July 24, 20 years, broad market delivered 13.3% return. But last 4.5 years return from Jan 20 to July 21%. And 15 years before that, market delivered just about 11% return. We believe going forward, returns will moderate and they are unlikely to remain so high as last 4.5 years. So if I have to summarize equity, time to go for Amar Bhai stocks over Anthony Bhai stocks, quality over momentum, reasonable valuation over expensive valuation, high floating stock over low floating stock. And most importantly, moderate your return expectation. The bull run which we have witnessed since COVID bottom may be coming for consolidation, may be coming for correction. At this point of time, small caps, be very, very careful. Mid cap, little bit careful. And large cap, one can invest if they are underweight equity and they still want to invest to maintain neutral allocation to equity. With this, I'll end my talk, Samir bhai, but happy to take questions.
Thank you so much, Nilesh bhai. You have actually helped us to understand, like, being an investor, is it a good time to invest or not? So, with your thought, like, we are very confident that India is going really strong. So, Nilesh bhai, before, like, we rolled out this session, we have internally asked our customer as well as our team to any question. So we have got couple of question. First is that what advice would you give to first time investor who are hesitant to enter the market due to current market uncertainties?
So, one, when you went for learning swimming, what did you do? Did you straightway jump into swimming pool? Answer is no. Did you just stayed out and tried learning swimming by watching videos and listening? Answer is no. You entered swimming pool with a float under the watchful eye of an instructor. Exactly the same thing you have to do while making investment. You take the help of, as they understand your investment objective and risk profile and recommend good mutual funds to you, and then follow the discipline. और इंस्ट्रक्शन जैसे कहे उसे फॉलो कर. Listen to Axis Securities and pick up right mutual funds for starting your SIP and jump into the swimming pool.
Thank you so much, Nilesh bhai. You have really covered it really well, and I hope this will be really useful. Just now we got a call. We got one question from YouTube. He is asking, in your experience, what are the common mistake investors?
Samir bhai, I lost you after what common mistake? Hello?
Am I audible, Nilesh
Yes,
bhai?
Samir bhai. Now you are audible. Yes.
Yeah. Sorry, there was some technical glitch. Just now we got a question from Mr. Ankush Mahajan. He's live with us on YouTube. He has asked one question. In your experience, what are the common mistake investors make, and how can they avoid them to achieve better return?
So, Ankush bhai, the biggest mistake investor make is they convert the trading position when they incur loss into investment. How can I be wrong? How can I incur loss? Eventually, share price will come higher than what I have bought. All this kind of ego results into running your losses rather than cutting your losses. So please be aware where you are investing, where you are trading. In trading, stop losses your dharma. In investing, average in and investing for long term is your dharma. The second thing, many a time people get lured by what they read in social media. And today there are so many people who are gurus of this market who recommend stocks and they actually start moving. But please remember, what works in bull market is not necessarily going to work in bear market. This is time to go for quality over momentum. So don't trust everything what is said in social media. Go to the brands which are worthy of your trust and confidence and money. They may be tortoise in this race, but they will be winner of the race. So my recommendation to investor is be realistic, invest for long term, and differentiate between trading and investing.
Nilesh bhai, thank you. There is another question from Ms. Chandni. She has asked one question: how many point Nifty can go down from here, and will it be a very deep correction?
So Chandni ji, there's no one who can predict where market is going to go. Warren Buffett very famously mentioned, I haven't met a person who predicts tomorrow. Second, the definition of deep correction is individual. I showed you beginning that we don't expect markets to go to 15,000 Nifty, where India's market cap to GDP ratio will be around historical averages. Why will markets not correct to that level? Because earnings are good, valuations are higher, but still within reasonable range for a long-term investor, and money flow is strong. Put all these things together, we don't expect deep correction. But please remember, never say never. Today market is assuming that Fed is going to cut rates in September. God forbid if they come and raise rates, undoubtedly markets will correct in US as well as in India. Today market is assuming that FPIs will come like revolving door, 2 months buying, 1 month selling, 1 month buying, 2 months selling. But God forbid if they decide to dump $100 billion like they tried selling in March 20 aggressively, then obviously market is not going to give easy exit. If I see foreigners selling cheaper and cheaper, lower and lower, I will buy him at a lower level rather than standing at one level and taking them out. So under current circumstances, we do not expect big corrections to happen in market, but that doesn't mean that corrections will not come. Markets will continue to rise and fall, go up as well as down, just like an elevator.
Very insightful answer, Nilesh bhai. We have received another question, that is how investors should approach asset allocation when building a mutual fund portfolio.
A very, very important question. And asset allocation essentially means don't put all eggs in one basket. Asset allocation essentially means we should generate real return, outperforming inflation through mix of debt, equity, currency, commodity, and real estate kind of asset class. How do you create asset allocation? One, first be fair to yourself and figure out what is your risk profile. If you bought in March, April, May, June 20 COVID period, you are aggressive investor. If you sold during March, April, May, June 20, you are conservative investor. If you didn't do anything and hold on to your investments, you are average investor. So first step is what is your risk profile? Are you aggressive? Are you conservative? The second is what is your investment objective? Am I investing so that I can take a foreign trip in next 6 months? Am I investing so that my son's marriage can be done after 15 years? Am I investing so that I can retire after 30 years? Shorter term time horizon will push you towards debt. Longer term time horizon will make you allocate more towards equity. So between risk profile and investment objective, you create the balance. How much to invest in real estate, how much to invest in precious metal, how much to invest in bonds, debentures, and how much to invest in direct equity. It's your risk profile and your investment objective.
Nilesh bhai, Thank you so much. You have answered really well. There is one another question from Ajendra Gohel. He is asking, is SIP better than trading? That is what he is asking.
So, for an ordinary investor or an ordinary trader, SIP is better than trading. But for someone as accomplished as Rakesh Jhunjhunwala, late Rakesh Jhunjhunwala, or Sri Radhakishanji Damani, oh, they'll make far more money trading than SIP. You have to be expert in trading to make money. 89% of people trade money loses. So if you are expert, trading is better than SIP. If you are not expert, then SIP is better than trading. But be fair to yourself. Are you in 89% who loses money via trading? Or are you in 11% who makes money via trading? That call you have to take.
Very well answered, Nilesh bhai. Actually, a lot of investors are still in dilemma whether they should do SIP or they should go direct with the equity market. I hope you have really cleared the doubt. Another question coming from Mr. Pallab Banerjee. He is asking, should we buy PSU bank stock or metal stock or FMCG stock?
So Pallabji, if you are playing momentum game, then maybe PSU banks are appropriate because there is a momentum in them and they are running ahead. But if you are playing value, if you are playing for long-term investing, my recommendation is go for FMCG. That sector looks better poised to deliver return over medium term. So investing to FMCG for long term, trading momentum through PSU banks for short term, but with strict stop loss. And if things go wrong, you will quickly turn around.
Nilesh bhai, another question coming from Deepak bhai Dave. He is asking, market is driven by sentiment and not by fundamental. As sometime government share going down, sometime defense and banking. So, as a layman, how to judge the market and take decision?
Deepak bhai, market is driven by three things: fundamentals, flow, and sentiment. In the short term, one or two factors can prevail. But in the long term, stocks are slave of earning power. Stocks will move as their profits will move. If you are confused about how the market behaves, what drives market, I'll recommend you to read research report of Axis Securities. That will give you good insights about the market. And you can also do SIP in equity mutual funds. Let the fund manager do all the investment calls on your behalf. So either I go to experts through SIP or I develop that expertise to understand all these things.
Nilesh bhai, thank you so much. Now we'll not take much of your time. We'll cover only three more questions. One question coming from Anup. Will RBI also follow the rate cut after rate cut in US?
So we believe RBI will eventually cut rates post US Fed rate cut, but market expects Fed to cut rates 3 times in between September 24 to December 24. We don't expect RBI to cut a single rate. They are more likely to cut rate in 2025 than 2024. Unlike US, our economy is doing well. Inflation is well under control. Growth is 7% plus. There's no need for RBI to follow Fed in cutting rates, as we are the fastest growing major economy otherwise also.
Nilesh bhai, a question coming from Nilesh bhai Duggar. He's asking, is market overpriced or is the right picture of the businesses and consumer growing confidence in the market?
Nilesh bhai, there is no one right or wrong answer. But as I mentioned, there are stocks like Anthony Buy, business is good, valuations are expensive. They are in industrials, capital goods, defense, railway, some PSU banks. On the other hand, there are stocks like Amar Bhai, reasonable valuation, reasonable fundamentals. They are in FMCG, private banks, technology, pharma, chemical kind of companies. When you buy Amar Bhai kind of stocks, you are expecting returns over medium term with limited downside. When you are buying Anthony Buy stocks, you are expecting higher growth. And in case that doesn't happen, then there will be bigger correction in the same.
Nilesh bhai, one interesting question just we got from Mr. Ramdas. He is asking ETF or mutual fund, what is better for an investor?
Ramdas bhai, you have to buy mutual fund, active mutual fund only when they deliver better return than index. If they are not delivering better return than index, then please go to ETF. At least you will get index equivalent return. There are about 2/3 fund manager which outperform benchmark indices on a 3-year basis. 1/3 underperform. So if you are among those 1/3, you have to go to ETF or move to 2/3 of fund managers which are outperforming benchmark indices. So stick with fund managers who can outperform benchmark indices over a period of time.
Nilesh bhai, thank you so much. There are a lot of questions which I can see in our chat. But if what we can do is we'll take up all these questions offline, and we will respond to respective investors' query separately. By Thank you so much for joining us today. We have covered a lot of ground and had some insightful discussion with Mr. Nilesh Shah. To recap, we began exploring the sector-wise India performance, domestic participation, increase participation increase leading to the limited downside risk. Even we have covered the consumption and technology sector, and Nilesh Bhai has beautifully captured the investor sentiment by giving example of Amar and Anthony. Your participation and questions have truly enriched our session. We appreciate your engagement and hope you found this information very useful. Thank you so much, Nilesh Bhai, for your time, your wisdom, and your commitment to educating investor. We look
Thank you,
forward to
Sunil.
apply your insight and continue this journey of our of the growth together. Once again, thank you so much, Nilesh bhai, and to all participation. Thank you so much. We look forward to seeing you at our next webinar. Have a great day. Till the time, have a happy and safe investing. Thank you
Thank
so
you.
much, Nilesh bhai.
Thank you.
Thank you.